All right. Yes, perfect. So first of all, let's quickly recap the previous video. We went over again, when that context is gone, what do we actually do? Again, there's the general rule of thumb of going down one time frame, but that's an extremely general rule of thumb, as in there's specific criteria that we need to take into account first before we can actually go down a time frame. So are we not creating context on the same time frame? No. Okay, we can go down a time frame. Does that time frame have context? Okay, we could go down another time frame. Maximum of 2 time frames right there. Then the second thing as well is that, of course, we need to understand the fair value gaps that are being created around us. So is there a fair value gap being created above us? It's extremely important to acknowledge that. Is there a time frame above us that is creating a fair value gap? Because that leads us to this video, which is high probability versus low probability. That is exactly what we are going to talk about right now. So understanding high probability versus low probability also comes through fair value gaps, but it's more so about stacking up arguments. So the way I view the market constantly is I'm stacking up arguments. If I want to be bullish, then there should be 100% bullish arguments without really having any bearish arguments at all. And vice versa, if I want to be bearish, there should only be bearish arguments without having any bullish arguments. Because if we have an argument in price action and we are stacking up arguments, and those arguments can also be seen as confluences, sort of like confluence. So if there's a lot of confluence going for it, it's likely there's a high probability of it playing out. If there's a lot of arguments going for one side of the market, then likely that side will play out. If the argument has great arguments for the bullish side, great arguments for the bearish side, then you are going to be 50-50 on price action. There's not a clear winner right there. So understanding that is, again, that is low probability. And that is exactly what we're going to go over right now. It's also understanding what I mean with high probability. So let's start off with that. High probability and low probability is, again, understanding first of all that it is probability. So it can be super high probability. A pair can be extremely high probability and it can still fail. It can still not play out. Because the way I always see that is high probability can be 80% chance that it's going to play out. There's still a 20% chance that it won't play out. And the reason that's so important to understand, and the reason I emphasize on that, is because a lot of people in the trading industry, they think high probability is binary. They think high probability equals, oh, I should win. And understanding trading is understanding probabilities. That is the difference between us and just straight up gamblers, the casino, is because we have the probabilities on our side. That is very important to understand. So again, it's not binary. Something that can be extremely high probability still has the chance of not playing out. So there's also the expectation you should have. As in, it's super high probability for a certain pair to do this, then still, that can still fail. I might still lose that trade. Even if we get the entry pattern, I still can lose that trade. So having an open mind and not having the expectation, high probability, so it should play out. No, high probability is there is a higher chance of it playing out than not playing out. And that is, of course, the same with low probability, where it's just inversed. As in, there is a low probability of it playing out. On a low probability day, I often see Twitter gurus, I see Instagram gurus, YouTube gurus even say, oh, who told you not to trade this day, blah, 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 blah. And I don't want to be negative or rant about them or anything. I just want to tell you an insight. I want to give you an insight, a perspective right here. Is that those people that say that, they don't understand probabilities. Because if I tell you, this is going to be a low probability day, and that is based on data. So on data, I know there's an 80% chance that this day will be absolutely shit. Very easily said. And there's a 20% chance that the day will be nice and can be traded and you can make profits on that day. Is it very likely that that day is going to be a great trading day if there's a 20% chance? No, of course not. So it's a low probability day. So when someone then says, oh, people mentioned it was a low probability day and look at how the price actually was, it was perfectly fine. Don't let anyone tell you if it's a low probability day. Then you don't understand low probability days. You just thought I said it's a losing day. You're going to lose. No. Then you don't understand the foundation of trading. It's all about probabilities. So again, I don't want to rant, but I want to have your mindset perfect, right? In order to understand everything that I'm teaching here, that mindset is also a huge part of it. So it's all about probabilities, and that is very important. It's not low probability means you are going to lose. No. There's a low probability of your trade playing out on that day. There's a low probability of price following through. As in, there's a low probability of price actually delivering. Meaning that if you were trading a 1 million account, a 1 million assets under management account, where you have a 1 million euros, 1 million US dollar in capital right there that you can risk, and you want to risk 1% on a trade, 10,000 US dollars on a trade. Are you going to risk that on a low probability day? Or do you think, well, maybe if I just wait another day, I can find a higher probability setup? Then why not wait for that higher probability day? And then I can also hear the argument from certain people, probably, or the thought process, because I also had that thought process, is like, yes, but I'm only trading a 10K account. I'm only trading a 10K account and I need to make percentage every day. I need to make profits every single day. Then you are in the wrong industry, because that is not going to happen right here. That we are going to, yes, there might be a trade opportunity every day. Don't get me wrong. With a flow trading plan, we're going to go over in the next phase, execution phase, there could definitely be a trade opportunity every day. If there's a trade opportunity every day though, then you can still be able to define between those trades that you take every day, the higher probability ones, where you have a less chance of losing, which means your win rate will increase, and which means your profits will increase over time as well. I always see it as, we are not looking to turn a 10K account into a million. We are looking to get a 1 million account to make 10K on consistently. That is the way you should view it. We want to have as much capital as possible and risk the least amount as possible. So risking 0.25% on a 1 million account is still 2,500 US dollar. That's an insane amount to trade with. That is insane. That is the goal that we should have. So again, that is a general rule of thumb, because I just need to tell this story before we actually dive into it, because there's a general rule of thumb that or there's two sides of this actually. There's people that are saying, or they are telling you potentially, you should just risk 4% on a challenge and you should go all out, go all in, because it's unrealistic conditions. And yes, I do agree with that. It's unrealistic conditions. But those people usually are in my position, where they are also potentially creating a nice amount of money or making a nice amount of money from another source of income. So they can allow themselves to consistently throw money at challenges to pass it. Whether they pass it or not, they don't care. It's almost gambling, where they just throw 4% on the challenge, boom, boom, let me pass it within the day. All right, perfect, next, fail it, doesn't matter. I have enough money to buy another one. If you're in that position, that's a great approach. That's a great approach to milk out profits. And that is eventually what we can get towards as well. But most people don't have the privilege to be in that position, don't have that privilege. So the way we approach things here is as well understanding that it takes time to grow that capital. Especially if you're starting with nothing, then we can take the business and the business can generate money itself. So even starting with a 10K account, you pass that, you get a payout, you get the refund slowly, very slowly. And then we can build onto that. We can buy another 10K. We have two 10Ks right there. All right, then we can scale to a 20K. Then we can scale to a 50K, to a 100K. And eventually, it's a slow and grinding process if you need to take that path. And there's nothing wrong with that. So we also need to understand that when people tell you, you should risk more on challenges, you should just do it very fast. If you don't pass in a day, those people are usually in a position to allow themselves to spend a shitload of money. And I mean a shitload. There are people out there in the space that I know that are spending 20k on challenges in a quarter and just basically gambling, which I do not really agree with that approach in itself. I do not really agree with that. I don't think it's at the core of trading. It's very important to understand as well. And then the next point I want to make is as well that hedge funds in the world, the best hedge funds in the world, they make a maximum of 30% in a year. Not in a quarter, not in a month, in a year. So if you make even remotely close to that, or if you make remotely close to that, then you are in the top percentage of the world trading wise. And if you make even more than that, then you are an incredible trader. And there are a lot of investors waiting for you, for your name on that contract, on that piece of contract, to get you to manage their money. And that again is things we can all go into later on. But this all leads me, and the reason why I'm telling this story is because this is at the core foundation before we can dive into high probability versus low probability. It's that understanding, that the understanding, but also believing and truly knowing. Because people understand it, but they don't truly believe it, I always say. And the logic behind that is that people will usually not, yes, you're right. But then still do the opposite. So they understand it, but they don't believe it. So usually it takes a lot of time to fail, to trade low probability conditions, to blow a lot of accounts, to then start truly believing it. So that is exactly at the foundation of understanding high probability and low probability. So the next thing that I want to go over as well is, of course, the technical side of high probability versus low probability, because there's a lot of technicals going into it. And the technical side is, there's a mechanical side towards it, and there's a subjective, so where it's not objectively seen. And the way I view that is through the arguments, we can get to a mechanical high probability condition or mechanical low probability condition. That is again stacking bullish arguments against bearish arguments. That's a mechanical manner of understanding, all right, what is high probability, what is low probability. Now, of course, I can also understand that I have more experience. So me having more experience, I can know more arguments. As in, you might not be able to come up with a certain argument, where I can come up with a certain argument to make. This is the part that requires time, that requires simply experiencing. And with that experience, of course, we get you prepared well enough. But at a certain moment in time, what is also mentioned in the philosophy video at the beginning, at the intro video of this mentorship, is that at a certain moment in time, we need to understand that it only takes time. All it takes is time. And that is very important. And with that time, with that experience, with the intuition part of understanding high probability versus low probability, is where then your win rate, your profits, your return overall increases a lot as well. So that is very important to understand as well. So the next part is, of course, how do we use those arguments? Well, if we first go over Canadian dollar CHF, later on going over euro US dollar again. Let's remove everything that's on the chart. Let's add the foundational levels that we've been using thus far. So here again, on the monthly time frame, we saw we were continuing lower. This is what we talked about in the previous video as well. We were continuing lower right there. We had usual context. In that usual context right there, we also had the lack of this bullish fair value gap being created. Because of course, if we want to create a bullish fair value gap right there, then we should leave this expansion phase open to actually create that bullish fair value gap, which at that moment in time, right there, doesn't happen. So we have that unusual context as well as that usual context. So right there, what we need to understand as well is that basically the things that we just did is stacking up arguments. overall, what do we have on the monthly time frame that could allow us to be bullish? So let's try to stack up the bullish arguments right here. Well, I can see that we are respecting this discount rate right there. So we can potentially have some bullish price action, which we also got at that moment in time. So we got this bullish candle right there. But then afterwards, at this moment in time, there is no monthly bullish arguments that I can get to be honest. Only thing I can think of is that we're coming very high into this fair value gap. So that's not very nice. But this unusual context that is being created right there then creates that perfect counter argument. Because let's take this back a little. Right here on Canadian dollar CHF, we are sweeping this low. So we are respecting that low. So the next argument I can think of is, all right, we are respecting that discount rate. So I do think we can come into this fair value gap right there to continue lower off of that potentially. That's the arguments I can get to, because overall we are bearish right there. We've had bearish fair value gaps, bearish order flows getting respected right there. All arguments that we are stacking up, if this is getting respected, the only bullish argument I can get to is we are respecting that discount rate right there. So we are sweeping that discount rate. We're sweeping that low. All right, then the consequence of those arguments are that we might want to trade into that fair value gap right there. That is currently the highest probability I can get to. But overall, the highest probability is still understanding that overall, this is still bearish. So here, next thing we see is we come into that monthly fair value gap. Now, for me, at that moment in time, I think, that is quite interesting. Because the bearish argument that we had, which was those fair value gaps, this order flow right there is almost getting annihilated right now. As in, it's not really getting respected. Those arguments are not really strong anymore. The bullish argument that we have at that moment in time is that we are potentially creating now a fair value gap. So we are creating the expansion phase of a fair value gap higher right there. That's an interesting bullish argument, right? So at this moment in time, we also need to understand that we just came off of bearish arguments. We are overall still bearish because order flow is still intact right there. Nothing has changed, but we do have a potential bullish argument there to make as well. So this, at this moment in time, is pretty 50-50 in my eyes. Then afterwards, we create this right there, that scenario. So this scenario, once we come back, we fail to create this bullish fair value gap higher, which would have led us to creating that potential order flow higher, right? Because if order flow wanted to switch right here, it should have created this monthly fair value gap right there to come into that, to then continue higher, create a new monthly fair value gap. That would have then overtaken the bearish arguments and would have been bullish arguments only. So I hope that, and I hope I'm explaining it clearly, that you can see the transition from bearish to potentially bullish to then bearish again. So it's a constant argument that's going on in the market. It's constantly an argument where if we just simply look at order flow, we already determined the arguments. Because order flow wise, at this moment in time, is bearish right there. Bearish, disrespecting the bearish fair value gap, potentially bullish. If we create that bullish fair value gap higher right there, it's again what we mentioned in order flow, it's 50-50 right there. So that is again where we have bearish arguments and bullish arguments, order flow wise. Then afterwards, right there, we only have bearish arguments to make. So now it's very clear that we just want to trade towards that low right there. Because at that moment in time, we only have bearish arguments to make. There is no bullish arguments anymore. We already got the rejection of that discount array. We only have bearish fair value gaps. We're not creating bullish fair value gaps. There's only bearish arguments to be made. So right now, if you go into the weekly time frame right there, and we create this weekly fair value gap lower, then this weekly fair value gap right there is what we can continue lower from. Now, this is where it gets interesting, and this is where potentially it gets a little bit subjective as well. So I'll try to explain it as best as I can. Because we also have this fair value gap that is sitting right there, and we also have this fair value gap that is sitting right there. Now, as a general rule of thumb, we know that if we are already closer to the drawn liquidity right there, then to make a retracement, the retracement right there is bigger than the move to the drawn liquidity. Then the first fair value gap that we are encountering right there, when we are closer to the drawn liquidity, means that that first fair value gap is likely going to get respected. Overall, is this the extremely highest probability thing we can do? No, because we still have this fair value gap above it and that fair value gap above it as well. So there's not one area that we can continue lower from. Overall, it's very clearly that we are continuing lower. But where are we continuing lower from? Is it the highest probability? No, because we have multiple choices. If we want to continue lower from something, then ideally it should only be one choice. There's only one level that we can continue lower from. That makes it extremely high probability. So the bias right here is extremely high probability. The narrative, it's high probability, but is it super high probability? No, because we don't know for sure if we are continuing lower off of that. But it is overall, again, high probability. Then right there, we continue lower off of that. Boom. Then we take the context low. I'm going to remove everything here because now we have created a lag lower right there. This new order flow lag lower right there. That order flow lag lower creates this fair value gap. This fair value gap is overlapping with the lows. Remember, when we take context, that is the ideal scenario that you want to see. So at this moment in time, we have this fair value gap, a little bit higher actually. This fair value gap right there. Is this a high probability to continue lower from? It's the highest probability that you are going to get. This is extremely high probability right here. Because the bias overall was already high probability. We were still bearish, etc. We have no bullish arguments to make. Only bullish argument I could think of, and it's very forced, is that right here, we are below that low, below that discount rate, so we might seek for a premium rate. It's only argument. Again, that's a forced argument. Whenever you have a forced argument, then likely it's already an argument you should not make. Because when the argument doesn't come into your mind very fast and you need to force arguments, then you are likely forcing a trade ID as well. So never force arguments. The arguments should come very natural. And of course, I understand that also takes time, right? So right here, if we are continuing lower, then we only have one spot right there that we are continuing lower from. The fair value gap. And potentially the overlap part, but mainly that fair value gap is where we are going to continue lower from. It's the only bearish argument right there to be made. So right here, once we come into that right there, and then we deliver towards that previous day low, that context is taken again, that was extremely high probability right there to potentially look to get involved. Now, when I say there are different stages of probability, we have 5 stages of probability, which is not something relevant that we are going to go into right now. It's going to be something that we touch on later on in this mentorship. But it is important to understand what I mean with high probability. When I say this weekly fair value gap right there is extremely high probability, I mean the first thing in that phase of being high probability is understanding that it's very high probability that we are likely going to get a rejection off of it. So any rejection might not follow through, just a rejection. That's the first stage. So the first stage is that rejection. Then the second stage is we understand that of that weekly fair value gap, we are potentially creating an entry pattern right there. But that already requires a little bit more higher probability, right? Because even low probability areas can expect a rejection off of it. Doesn't mean they will provide an entry pattern. So once they provide an entry pattern, which requires a little bit extra off of price action, that is even higher probability already. Then again, that is what I mean. With high probability, I'm understanding that there might be a rejection and there might be an entry pattern. Then the third thing is that entry pattern will play out. So we will have a winning trade right there. Then the fourth one is understanding the last part of that high probability is that we follow through. Sorry, this is not the last part. That's the second last part right there, that we follow through and take context. So we take the target. We take the context low right there. Then the fifth part is understanding that we create a new FVG off of that. And those are the stages. Those are different stages of probability. So these are not the 5 stages of probability I was referring to a little bit earlier. But this is what I mean with high probability. So these are different levels where the first part is we understand there might be a rejection. That's pretty high probability. That's the highest probability that can happen. The second thing is that there might be an entry pattern. All right, that is the second part that could happen. That is pretty high probability. Then the third part is the entry pattern. So we have a winning trade from that entry pattern. That is also, all right, pretty high probability. That is what we want, right? That is what we want. Then the fourth part is, which is already a lower probability of happening. It's again still that high probability. But when I refer to there's an 80% of that, of this fair value gap actually playing out right there, that weekly value gap lower, I refer to there's an 80% chance of getting a rejection. Then there might be a 75% of getting an entry pattern. There might be a 70% of that being a winning trade. There might be a 60% of following through towards that low right there. There might be 50% of creating a new fair value gap off of that, where we create a new fair value gap, which we are currently clearly not doing right there. Again, those exact numbers are a little bit scuffed right there. I would argue that the rejection part is about 95%. There's a probability of 95% of getting at least a rejection. Around, I would argue, 80 to 90% entry pattern. Then around as well 70 to 80% for that being a winning trade. Around 60 to 70% for that following through, and it's the same for 60 to 70% for creating a new fair value gap off of that. But that is important to understand, that the lower we go right there, the more we demand off of price, the lower the probability is going to be. So right here, yes, we got our entry pattern right there, which we'll dive into next week. Yes, we got our entry pattern right there. Yes, it was a winning trade. Yes, we followed through to take that target. But we did not create a new fair value gap off of that. So that is, again, understanding the probabilities right there. That it goes deeper than when I just mention a fair value gap. That is high probability. It is not that that fair value gap is super high probability, or as in, I do not mention this fair value gap will just create a new fair value gap and will forever live in a utopia and forever continue lower. No, I mean that I can now expect the rejection there. That's the highest probability. Then already a little bit lower probability, I can expect an entry pattern. Potentially that entry pattern is a winning trade. Potentially we follow through and take the target. Potentially we create a new fair value gap off of that. The reason this is important is because this is also important for your eventual trades. Where if you are in trade, and let's dive into this really quick without going too in depth on it, is when you're in a trade right here, and you take this trade, for example, covering that high, then you understand, ideally, you want to target something in between the context and not outside of the context. Because targeting something like this outside of the context low requires the fifth point right there, which would be the highest probability, or sorry, the lowest probability thing of happening inside the high probability price action. So let me state that clearly again. Where if we have the 5 points again, and let's bring them back up, then we understand that the first thing is rejection. So if we dive into that weekly value, the first thing we can expect is a rejection. All right, we have a rejection right there. Then the second thing we can understand is that we might create an entry pattern. All right, we also have an entry pattern. That entry pattern in itself can also be a losing trade, right? It's probability, so it can be a losing trade right there. The third part of that entry pattern, or the third part, is understanding that it can be a winning trade. All right, nice. That is a little bit lower probability because, of course, before you get to a winning trade, it is higher probability for an entry pattern to show up than for it to automatically be a winning trade. And the way I see that is we constantly have a filter, as in we now have an entry pattern. Yes, that was the highest probability thing that could happen, an entry pattern right there. But then the win rate comes in of that entry pattern, where now we have an 80% win rate of winning that entry pattern and a 20% win rate, losing rate. 20% that we might lose that entry pattern right there. So that entry pattern that was 100% showing up is now divided into, again, 80% winning that entry pattern. 20% of the times I lose that entry pattern. Then the next part is that winning trade, if that's inside the context, I might have a great chance of reaching the target, as in winning the trade. Then the fourth part is following through, where we actually take the context low instead of just a rejection and then we continue higher. Inside that rejection, we can still win the trade. We don't need price action to take that context low right there to win a trade, because a 1 to 2 right there would have already gotten you out at a trade right there. So sometimes that will also happen where we won't reach the context low, but you still win the trade. Perfectly fine, because analyst is just the first part of trading. It's just the first part. So an analysis playing out does not necessarily mean that you are a great trader. I know great traders that have not the greatest analysis. I know great people that have a great analysis, but they just simply can't make it work trading wise, execution wise, which is why both parts are so important. So right here, the lower probability action right now, the fourth action, is actually following through and taking that target. Then the fifth, the lowest probability thing of happening. And when I say lowest probability, I mean it's the lowest probability thing of happening in a high probability price action market. Meaning that overall it is high probability. It is higher probability of happening than us continuing higher right there. But it is low probability of happening if we define the steps even more inside that high probability. So overall, the high probability can be defined more by these steps right there, where low probability inside the high probability, so still a 60 to 70% chance of happening, is creating a new fair value gap off of that, which means that this weekly value gap would have created a new weekly fair value gap off that, which means that your target should also be reasonable. If you target something like this right there, then understand that is the lowest probability thing of happening inside the high probability price action, because that right there, the lowest probability thing of happening, requires us now to create a whole new fair value gap, a new expansion phase off of that previous fair value gap. This might sound a little bit confusing, and I can fully understand if that is a little bit confusing, and this will take time as well to fully understand. Don't worry, it's just understanding here which levels you are expecting. What are you expecting off of price? If you are expecting a target like this, then just know that we need to create a whole new fair value gap of the weekly time frame right there to actually reach that target. So that is, of course, lower probability than just following through and simply taking that target. And that is, of course, even lower probability than just winning the trade of taking a 1-2 inside the context. And that right there is lower probability than actually winning the trade. And that right there is lower probability than just an entry pattern showing up. And the highest probability thing of happening inside the high probability price action is just getting a simple rejection, which could have been the smallest rejection, because a rejection is likely always going to happen. 95% of the time, it's always going to be there. So that is defining a high probability with even more steps to it. It's getting your mindset, that expectation right. That is very important right there. So if you lose a trade because you had the target right there, or it's now a break even, then you understand, yes, that is pretty normal, because again, it was the lowest probability thing of happening inside that high probability context right there. That is very important to understand. So that is how we define high probability and probability itself versus low probability. And we went from bias, narrative, to boundary, to target right there. And then the entry pattern is something we're going to touch on next as well. Now, this is not it. we're going to have a few more examples. I want to ingrain this fully into your mind because I can understand that this could be for sure a confusing topic and a little bit overwhelming as well. So definitely, I always advise watch videos a couple of times and it will make a lot more sense as well. So let's go over the next example, which is GBP US dollar on a weekly basis actually. So if we take a look at GU, then I want to pay attention to this price action right there, where we created a new order flow leg higher. And at that moment in time, I remember this price action very clearly actually, because I was actively trading that as well. And at that moment in time, the money making team was still pretty young. And I mentioned at that moment in time that the only thing price can really do right here is continue higher. Because we had a weekly fair value gap sitting right there. That weekly value gap was even overlapping with that order block right there. There are zero bearish arguments to be made right here. Where on the monthly, we are potentially still creating, in the midst of creating a monthly fair value gap higher. We don't have anything to trade off of from the left right there. Those weekly fair value gaps are again targets. They are not something to trade off of. So the only thing we can do right here, the only thing we could have done was continue higher, simply because there were no bearish arguments to be made at that moment in time, which then eventually that is super high probability argument, because the arguments overall, the super high probability trade, because the arguments overall, the bias was just bullish, nothing to discuss about. It was completely bullish. Narrative, nothing to discuss about. Because this area with that weekly value gap, with that weekly order block right there, is the only area that we can continue higher from right there. Meaning that we don't really have a choice. It's super high probability right there, extremely high probability price action to continue higher off of that. And that again creates a super high probability boundary because you only have one boundary right there, which is basically the fair value gap. Trading into that fair value gap also gave us that we automatically trade into the order block right there, which is again, there's no confusion to be made at all right there. If we are going higher, where are we going higher from? There's only one choice to be made right there. With the bias as well, there was only really one choice, just bullish overall. So that makes it extremely high probability to trade towards the right side right there. Now, we have been going over high probability examples right here, and I think it is also more beneficial to go over quite some low probability price examples, which is arguably more important because those are the ones that you want to spot. Because if you can understand low probability, then you can understand high probability. That is very easily said, of course, what we want to do. So the first part is, again, I want to go over a little bit on Euro Canadian dollar as well. And why I want to go over Euro Canadian dollar is again to reinforce the idea into your mindset. Where right here on Euro Canadian dollar, overall we were just bullish. We can look to continue bullish order flow on the monthly as well right there. And on the weekly, we were creating this nice fair value gap that is sitting right there. And we had the overlapping part as well right there, which is extremely nice price action right there. The only difference we have between this price action and the example we just saw on GU is that here we also have fair value gaps lower. So again, there is no reason to come back to those fair value gaps, but that does create an opportunity to potentially come back, where GU just didn't have any opportunity to continue lower right there. But here I would still, so again, the reason I mentioned that is because within the high probability, we can still define a little bit more high probability. So comparing GU to Euro Canadian dollar, GU was definitely higher probability at this moment in time. But we can also understand that this is still extremely high probability, where we can see that this is currently not playing out. This is currently not continuing lower because we did get the rejection right there off of the weekly, where if we go into the 4 hour, we came into the weekly fair value gap and we got a rejection right there and we just didn't follow through. That again leads me to the next point, where we went over, all right, you have the high probability, higher time frame, you have the bias, high probability, narrative, high probability. then the next part is that boundary, that target, that context right there. Eventually what we create that entry pattern as well. The rejection, high probability. The entry pattern, high probability, because we got an entry pattern right there. Did it play out? No. All right, we understand that. We failed to follow through eventually. The fair value gaps are telling us, of course, right there, that we are just not willing to push higher right there, which eventually led to us having a low probability condition eventually right there. But first, we started off with extremely high probability. And that's again the same premise that we understand that high probability conditions, they can still be, they can still lead to a loss. We can still lose that trade. Just because it's high probability doesn't mean that we will guaranteed, 100% guaranteed, win a certain trade. Extremely important to understand as well. Which makes it scary, right? Because that is all the reason why people fall into a shiny object syndrome in the first place. Because they need that reason. They need that understanding. They need that knowing. They need to know when something is going to play out. They need to know when they are going to win. They need to know when they are going to lose. They need to know everything. Well, they need to know when, where, and when are the winners only. And that leads people to come into a shiny object syndrome then eventually. Which, if you have that, then of course you have still quite some process to make. But it's understanding that that's never going to happen. It's always going to be uncertain. It's always going to be probabilities. Very scary, right? Once you come to sort of, once you come to accept that thought, it becomes quite easy trade, because you can just trade and eventually you know the probabilities are on your side. Of course, that takes as well a lot of time and experience, but it's a scary thought. I know. But it is the reality of trading and basically the reality of life as well in itself. But again, so now I want to go over a few examples right here on Euro US dollar as well. What we started off with, to go over low probability price action. We mentioned yesterday that we had this daily fair value gap potentially higher, and we even had the 4-hour fair value gaps higher right there. This 4-hour fair value gap after the context has been taken. The daily context has been taken, and we can look to trade off of that. Is this high probability? Off of a daily standpoint right here, we could argue, well, overall, we don't really have bearish arguments to be made, except for this candle, the Wednesday candle. This candle right there is a pretty bearish candle, because it didn't leave behind a clear fair value gap overlapping with the high very nicely. Overall, I would argue, all right, this is pretty bullish on a daily standpoint. But if we zoom out, we have a weekly fair value gap below it. Whenever you have this scenario where you have something on a time frame, above you, a fair value gap below you, above you, whatever the current context is. So here the current context on the daily was this low is protected right there, because that is the new order flow leg higher. Well, this low is the last thing of protected, because that low is absolutely not protected, because it's the low, or it's the high, sorry, of a weekly fair value gap, which we then want to come into, of course, to then potentially continue higher off of that. So the highest probability thing here is not trading off the daily fair value gap, because the daily here is not in context of the weekly. Once we come into that weekly, now we can look for a higher price, because it's consistently monitoring, and this is what we're going to get very in depth on in the execution phase as well. You're consistently monitoring if there's no reason to come back. So here on the daily time frame, at this moment in time, is there a reason to come back below this low? Yes, because there's a fair value gap below it right there. Was there a reason to come back below this low right there? No. Why not? Because at that moment in time, is there a fair value gap below that price action? Well, no, currently not, just after that week closes. So then, yes. But at that moment in time, no, not really, because we don't have a weekly fair value gap below it at that moment in time. Only once the week closes right there. So eventually, yes, of course. But that right there is, there's a difference between this price action and then this price action. Because now we have context taken, so the daily has followed through as well. Respect the discount rate, premium rate. From that premium rate, we can now look to trade into a discount array. That discount array is not the fair value gap getting respected right there to continue higher, because that right there is where we have a weekly fair value gap just below price action, which is, of course, the daily is not in context there anymore. So that should hopefully make sense by now as well, that the daily fair value gaps need to be in context of the time frames above it. So if there's a daily fair value gap and a weekly fair value gap, which fair value gap will win? The weekly, most likely. So the weekly is higher probability always. The higher the time frame, the higher the probability. That is very important. So right there, then eventually you can, of course, look to continue higher off of that as well. Which currently, actually, we are seeing that we are creating an ST right there, which is quite nice as well. Not really relevant, but once we are slowly getting into the execution phase, then this is definitely becoming relevant right there. And this might very well be an example that we'll be using next week as well. So right here, I want to go over another low probability scenario. This was the first low probability scenario right there, which again is quite easily understood by just understanding the fair value gaps and which one is the stronger fair value gap, right? So if you have an order flow lag higher, but the last line of defense of that order flow lag higher is below that is a fair value gap on the time frame above it, then that order flow lag is not high probability to hold. All right, and that takes us to Canadian dollar JPY right here. So I want to go over an example of seek and destroy conditions. And seek and destroy conditions, again, can be also found through arguments. Now, we have a general rule of thumb on seek and destroy conditions. The general rule of thumb is when two fair value gaps are not following through, you want to stop trading that pair because likely on that time frame, on that pair, we have seek and destroy conditions, which is what we are seeing on Canadian dollar JPY. Now, seek and destroy conditions is also defined by understanding that we are not respecting fair value gaps and we are just simply disrespecting fair value gaps, not following through on opposite fair value gaps, all that. That's exactly what we're going to go over right here. So understanding seek and destroy is, again, understanding fair value gaps, where on the weekly time frame we had a bullish fair value gap sitting right there. So that's the first weekly fair value gap essentially. We also had this weekly fair value gap, but let's just take this one right there. That weekly fair value gap. And if we go into the daily time frame, we had this daily fair value gap sitting right there. All right, at that moment in time, I would argue this is still pretty normal price action because right here, we just are coming into the weekly fair value gap to continue higher off of that, disrespecting the bearish fair value gap. Perfect. So then that means we should ideally hold this daily fair value gap to then push higher off of that. That doesn't happen. Okay, we might be bearish. We might be bearish at that moment in time, so we can continue lower off of this daily fair value gap sitting right there. That daily fair value gap also does not hold. Then we have this daily fair value gap right there. Does that create a new daily fair value gap off of that? Also doesn't create a new daily fair value gap off of that. So we have this daily fair value gap right there. Does that hold? No. Then we have this daily fair value gap right there. Does that daily fair value gap hold and create a new daily fair value gap off that? No. So right there, you also have this daily fair value gap right there. Now, the thing I'm trying to show you here is called the loyalty test. This is what we use to determine seek and destroy conditions. The loyalty test is basically understanding that, all right, you fooled me once, you're not going to fool me again. Fool me twice, all right, you might fool me twice, but the third time, definitely not. So you are not going to fool me over and over and over. And that is important to understand here. And the things that are fooling us are the fair value gaps here. So the first time we did not follow through on that bearish fair value gap. But again, that was explainable. All right. Second time, we did not follow through on that bullish fair value gap. That's a bit odd. So if we are not following through on that bullish fair value gap right there, then we should follow through on this bearish fair value gap. If we do not do that, then overall we are in seek and destroy conditions. Because right there, the first bullish fair value gap we should have continued on, continued higher from, did not do it. Should have continued lower from that. Did not do it, seek and destroy conditions. So that right there, if we, again, that first daily bearish value gap, I do not count because that is where the weekly value gap was. So it's not that crazy that we disrespect that. But if we are supposed to respect a daily fair value gap, a bullish daily fair value gap, or any bullish fair value gap, and we do not do that, and we create a bearish fair value gap off of that, so an opposite fair value gap on the same time frame, and we do not respect that fair value gap as well, then that is seek and destroy conditions. So two fair value gaps right there. that's both a bullish and a bearish value gap, that both are not getting respected, that leads to seek and destroy conditions. This is also one of those things where it also takes experience, because I can that general rule of thumb is a great general rule of thumb to use, but I can confidently say that I'm pretty good at finding seek and destroy conditions as early as possible, meaning that I can recognize the early signs of finding seek and destroy conditions as early as possible, which is because I have been caught up in seek and destroy conditions enough times to now understand that I should avoid them. So I can see them coming more so. So this right there, yes, it's a nice daily value gap to potentially trade off of. For sure, I agree with that. But again, once we don't create that new daily value gap higher off of that, it's extremely suspicious. And then after this, all this price action on the right side is where we can confidently say, yeah, I don't really want to get involved here. Because that is exactly where we are expecting seek and destroy conditions, because we are just simply, based on the loyalty test, not following through on fair value gaps. And that is exactly what you want to avoid right there. That's extremely important. Which is also the thing we saw actually this week on some of the indices, where it was not really high probability. Because we can clearly see right here that we have this consolidation. On the daily time frame, we are not creating daily fair value gaps right there higher. We are also not creating any daily value gaps lower. We are just consolidating right there. We can see that by the lack of volatility moving higher. A very easy thing you can do is just understanding the last fair value gap was created on the 15th of November. That's quite some time ago right there. The last daily value gap was created then. So since then, we have not created a new fair value gap in the second half of November. That's pretty suspicious, right? So after that, on the 4 hour, we are also at this moment in time not respecting fair value gaps really. We are not really following through on them. So then after that right here, we can see that we have fair value gaps lower. They should have pushed lower, which it didn't do, which we actually had the example earlier in previous videos of. This was playing out nicely right there. Once those fair value gaps right there are not following through, that becomes suspicious again. That is where seek and destroy happens, because following through of fair value gap should be that should happen. We should follow through on either bullish or bearish fair value gaps. If we are not following through on both sides, then that is seek and destroy right here, which can also come with the lack of volatility in certain months, etc. It can also be seen more, which is all things we are going to dive into even deeper. I just want you to get a general idea again of high probability versus low probability. So this is where seek and destroy happens right there. Now, the next part that we need to understand is that we have usual context and unusual context. So I also mentioned in the example right here, once I showed you the example right there, that case study, I mentioned the highest probability thing for price to do at that moment in time is to continue higher, because overall, very easily said, the bias is bullish. The arguments towards the bias have just been bullish. The narrative is we can continue higher off of that. If we want to come back towards that discount rate to continue higher off of that, because the bias is bullish, and there's a reason why the bias comes first, because overall we need to understand we're just bullish or bearish. The narrative is a second thing, as in it's lower probability for price to actually come into the discount rate that it wants to trade higher off of than just to continue higher. What do I mean by that? It's a guarantee at this moment in time. It's the same with the 5 steps that we went over on rejection, etc. It's a guarantee that the bias is going to be bullish right here. That's a guarantee. It's not a guarantee that we will come into this discount rate to already take out this target right there. So that is maybe 80%, maybe 70% right there that we're coming into that discount rate. If we do come into that, then that is, I would argue, almost close to 100% that we are going to deliver towards this high right there. So that is important to understand, because that leads us to, if we have unusual context right here, and this is why I mentioned the unusual context right there is lower probability than your usual context on the higher time frame. Trading towards something where you are expecting usual context from. So this weekly fair value gap right there, trading off of that weekly fair value gap is the highest probability price action you can get. Trading towards that weekly fair value gap is lower probability because overall we are just bullish. So the bullish side is almost 100% probability. We are going higher. But where are we going higher from? Yes, likely if we come into that weekly value gap, we are definitely continuing higher off of that. Doesn't mean we should come into it though. So trading towards it is lower probability. It's on the lower side right there. That is again understanding in depth the arguments that can be made right there. Because the argument is that we're overall bullish. So is it smart to take a bearish trade? No. That is very important to understand as well. So right here, the lower probability side is again taking shorts right there. The higher probability is waiting for the weekly value to be traded into to continue higher off of that again. So this is understanding as well the difference between usual context and unusual context, where unusual context is usually a little bit lower probability under certain conditions as well. A condition like this, for example, where overall we're just bullish and trading into the weekly value gap that we want to continue higher off of, that is a little bit lower probability than just your usual context. Where, for example, the Canadian dollar CHF, what we mentioned, where we also had the monthly right there, the monthly right here, creating this unusual context right there inside the usual context. This is way higher probability than the example on NASDAQ. Because here you are not forcing to trade into the premium array that we are continuing lower off of. Which is the same thing right here, which overall we're still bearish right here. So at this moment in time, we are not creating a new fair value gap lower off of that. It is understanding that overall we are still bearish. So to call a bottom right here and to say that this unusual context is a very high probability to play out, that's unreasonable. That is not logical, and that is definitely not something, or at least you need to understand the difference in probabilities right there. That is very important to understand. So again, you would stack up bullish arguments versus bearish arguments. If you can understand that right there, then you've understand this video. The basics of high probability versus low probability. Understanding that is extremely important because it's not necessarily can we find context, etc. Yes, we can always find context. There's context everywhere. And the next step is understanding, is it high probability context? So is it high probability for that context to play out? And we can understand that by understanding that if we have bearish context, there's no reason to create any bullishness. There's no reason for bullish price action, which we saw perfectly on GU right there. Let's go over it one last time, where right here, there is just simply no other argument to be made than to continue higher off of that. That is important. So the longs right there are extremely high probability as well. Where at this moment in time, once we come back lower a little bit, well, there it's a little bit confusing, right? Because there you're bullish overall. We're not really creating any bearishness, although we are not respecting the bullish price action. So there is where, again, it becomes 50-50 because you can't get to a clear argument on either side of the market. This is something, again, we are going to touch on way more in depth, and it's going to come back over and over and over. So if you do not fully understand it right now, that's perfect. We are going to go over it way more in depth as well. All right, perfect. Thank you.